Perfect. Thank you so much, Tanya. Thank you so much, Traders Talk Live, for having me here today. My name is Anka Metcalf, and I will be presenting today how to maximize profits and minimize losses using intelligent stops. Now, this is the presentation that I have done for the first time last week in Chicago. It was about exactly 1 week ago. So for those of you that do not know me, I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm specialized in educating individuals how to day trade and swing trade the equities and the futures market. I have been doing this with my own accounts for the last 15 years. And prior to becoming a professional independent trader, I came to this industry with 10 plus years in investment banking experience. I'm also the designer of an institutional proprietary trading system, which is based on support resistance. So what else is new is that I watch 7 layers of support resistance. So there's so much more than meets the eye, the basic supply and demand. And when you're looking at charts, and especially days like today, where we had that avalanche to the downside on Friday, and we pretty much are basing at the lows when we're looking at NASDAQ. I trade futures a lot, day trade futures a lot, but if you should be trading stocks, definitely the one indicator that you need to watch correlated with your stock is definitely going to be what? The Qs or the SPYs, right? So you have to keep an eye on what NASDAQ is doing. You have to keep an eye on what the S&P is doing, and you have to keep an eye what Dow is doing. All right, I also specialize in specific trigger times. So what that means is that not only that I'm looking at precise times, but I'm also looking at correlating them with my support resistance areas. And therefore, I have only 4 precise times through the morning session, times that are proprietary to our method that I'm going to be sharing with you in today's presentation. I also look at price zones, and there are only 4 price zones that are prone to institutional buying and selling. I look at chart synchronicity and divergency. This is very important because this is going to give you a gauge of what is stronger and what is weaker in this trading day, within a trading day. Not only that, but it gives you a glimpse into possible rotations that may happen from one sector to another. So for instance, a day like today, we have the mini NASDAQ, which is down. Guess what? 84 points. We have the Qs that are down. We have NASDAQ that is down. So therefore, we have relative weakness coming from this NASDAQ. And guess what? We have one index that was particularly weak on Friday that is positive today. So that means strong imbalance. And more about this as we're going into the presentation today. I also have a strict set of trading rules that enable myself and my traders to identify trades with ease, and also a 10-point scoring system designed with the same scope in mind. All right, so if you guys want to learn more about our method or about myself, you could actually go to tradeoutloud.com. You could follow us on Twitter. I have a very active presence on Twitter where I post a lot of trading ideas, whether they're stocks or futures. So you get a lot of trading ideas for free for Twitter by watch list, etc. And also a lot of our recordings are right now on YouTube. In fact, last night I did post a market outlook for the futures market. Next week we're going to add on to what we're doing right now, and we're going to have one for the stock market. So feel free to visit our YouTube and become a subscriber, so you're notified whenever we post an educational link there. I just came back from the Futures Trading Expo in July, and it was a blast. I loved it. I also came with a very bad cold, so if I should mute the microphone from time to time, it's just that I don't want to hear. I don't want you guys to hear how bad I'm coughing. All right, here is my agenda for today, and I promise you a very special presentation, and a presentation that you're not going to hear very often. I'm going to have a class on this presentation in the 2nd or the 3rd week of August, and it is going to be a blast. I already have a lot of requests. Traders that are already in my trading room are going to have access to this class for free, but this is not something that we are even advertising just as of yet. So I'm going to be speaking about what is a stop and a stop loss order. So a lot of you guys may or may not know how to place stops. So I'm going to share with you how I do the stop the stop orders and what areas I consider for the stops, whether you're in an uptrend or a downtrend, whether you're in a long position or a short position. I'm also going to be talking about the art of placing stops, because placing the stops is an art, right? Especially in today's market. How many of you guys in here, you know, took a trade, placed a stop, took you out, and then the trade ran without you? So you were literally dinged out of the trade, okay? I have my hand raised, okay? So yes, it had happened to me, and I have studied the phenomenon. That was before I've heard that, and you can Google this. This is 100% information that you can find it on the World Wide Web. Your broker is selling your orders, where you have your stops, where you have your entries, and there are algorithms that are set immediately to ding you out of the trades, okay? So they could get more liquidity, so they can reverse the trade. So institutional buyers can have more liquidity to participate in the trade higher. So they're the ones that are pushing the price lower, dinging everybody out of the trade for the reversal to happen, for them to get more contracts or shares on. All right, so I'm also going to be talking to you about intelligent stops and multiple functionalities. So right now, the importance of the stop loss. How would your trading day look like if you would not use the stop loss order, okay? Or if you would not lose a stop loss at all, right? So how would that look like? Well, let's have an honest discussion about the mighty stop loss. All right, let's talk about, first of all, what does the stop do, right? What does the stop do? Well, first of all, what is it doing? It protects your capital, right? The number one thing in trading is protecting your capital. This is the reason why we allocate a certain amount of risk per week, and we divide that certain amount of risk, the money, the chunk of money that we allocate for the week, we allocate it for our 5 trading days, right? And each trading day, what do we do then on? For each trading day, we divide that into what? Into 4 or 6 bullets, depending on how aggressive you are as a day trader or even as a swing trader, okay? So number one, it protects your capital, right? So you have an allocated risk amount for each and every single trade, for each and every single day, for each and every single week. Number two, it helps you measure the risk for each trade. Now, what do I mean by that? You see this little guy here with the tape measuring? He's measuring the distance between your entry and your stop, because depending on how that shallow or how wide that risk level is, that will definitely decide whether how many contracts or how many shares you're going to enter the trade with, right? So that is the only element that is unknown. What is the known element? The known element is your capital preservation, meaning your risk per trade. So if I allocate every single day $500 per trade, what does that mean? That I'm going to be measuring my entry for my entry point and my stop loss point, and I'm going to be adjusting to that specific level. All right, now what does the stop do? Remember the stop? Well, it helps you position size, like I've mentioned, right? So now that you have the measurement, guess what? Now you can position size. You know how many contracts to get. You know how many shares to get, depending on that distance, right? All right, so the stop is basically what? The stop is basically a pre-planned exit. The stop strategy is the second most important part of the trade. What is the most important part of the trade? Does anybody know what is the most important part of the trade? Okay, one of the most important part of the trades is actually the pre-planning, okay? It's actually the pre-planning. I'm trying to get some questions here. Okay, I'll answer all of your questions, and in fact, they're included in this presentation. And so if you can please, hold on to the questions until the end of the session, and I'm going to try. Some of them are really amazing because they're actually things that we're going to be talking about in this presentation. So just have a little bit of patience, okay? So this element defines your risk and it determines your position size. So the stops should be placed, guess where? Either above pivots or below pivots, right? When do you place them above pivots? You place them above pivots for short positions. Now, I'm going to try very, very quickly, okay, to bring some charts up here. Let me know, just give me a heads up. Just give me a yes or a one in this chat box if you could see the charts. Okay, because what I'm referring to right here, this is a pivot, right? Okay, perfect. Thank you so much. Okay, this is a pivot high right here at 72.50. So if I was to take a short, okay, if I was to take a short, where would my stop be? Okay, this is the exact high, the 72.50.75. Am I going to place my stop right there? No, I'm not. I'm going to give it a little bit of room, right? You always have to give it a little bit of room, a little bit of wiggle room. Why? Because they don't stop there. One of the reasons a lot of traders stop out of trades is they put their stops at the precise high area or low area. So when you're shorting, you're placing your stop above this high area, okay? In volatile markets, you're going to see, there are two things that you're going to see. Number one, volatility, right? And volatility is going to create what? A wider distance between your stop and your entry. Wide distance. And in fact, take a look at this range today. 72.02 for the low, 72.50 for the high. It is incredible. It is a 48-point range on the 15-minute chart. In another trading environment, you would actually play a 15-minute range. Is it playable now? No, it's not. Okay, no, it's not. From the day trading perspective, it's not. You're not going to play a range like this. We're day traders. We're looking for tighter stops. Okay, but at the same time, you're going to be looking at the pattern because the pattern is the only factor. It is the only thing that influences your entry and your stop. It's not like, oh, you know what? I want to take a long, but I'm going to do it here and I'm going to give it a 200-point stop. No, that's not the way you trade. And if you have had multiple stop outs in trades, this is your number one cost. Okay, how about on long positions? If I want to take a long position, what do I do? Okay, I'm going to refer to Russell here because it's a little clearer. Okay, and we had the drawdown back into the 1662 right here, and we had the turnaround, right? So right now, if I was to take a position long in Russell, is Russell ready for a position long? No, it's not. Why? Because first of all, this is a 15-minute chart, and this is regardless of what kind of time frame you're looking at, right? But if you're looking at a 15-minute chart, you're going to be looking for a 15-minute trigger. A 15-minute trigger is going to come at 66.8, okay? So you're going to want to see the price trade above that prior candle high to test it, and that is a viable trigger. If you're going to take it here at 1664.6, yeah, you're going to have a less of a risk, right? Because you're probably going to place your risk below this low. This low is 1662. So guess what? You see this pivot low, you have to wait for the pivoting effect. Now, this pivot is not yet fully formed. And why is that? Well, because you can see it here, it has not triggered. So you can only speak about placing a hard stop only if you have a trigger, okay? So obviously for long positions, you're gonna place your stops below the pivot lows and you're gonna give it that wiggle room so you're not gonna get dinged out of the trades, okay? Now, the other thing is that once the stop triggers, this is just pure terminology, but I want you guys to learn the basics and the terminology is one of them, okay? So number one, if you're in a trade, and let's say, remember we talked about this, we talked about this Russell, right? So let's say we get in and it triggers 1667. We're in the trade, it moves a little higher, and then guess what? It's got rejected at that price point and it goes below the 1662. What does that mean? It means that we are stopped out of the trade. The stop out has a loss connotation, okay? Has a loss connotation. And at that point, it means that you have lost your risk amount allocated for that trade, okay? So you're stopped out, meaning you lost in that trade. Now, when the trade triggers, remember it trades above that prior high, that reversal point, let's say whether you're trading a 2-minute or a 5-minute or a 15-minute if you're a day trader, if you're a swing trader, if it trades over a 1-hour high or a 4-hour or a daily or a weekly, whatever it may be, whether you're a day trader or a swing trader, this applies to anything, okay? Remember that if it moves in the desired direction, what are you going to be doing, okay? You're going to be raising your stops, right? Because you want to do what? You want to preserve your capital. So you're lifting the stop up. Now, obviously, there are certain rules where you can lift stops and, manage the trade. We're not going to get into managing trades. But when you're lifting the stop, it means that you're raising your stop a little higher. In case of a drawdown, you're going to get what? Trailed out of the trade. Trailed out means you got out of the trade with money. Even if, let's say, you're having a trade that is running a little higher, okay, and you're raising the stop, right, and to break even, because you want to lock in that break even, and you want to lock in, and again, if you have a very small account, you have to look for your capital preservation, and as soon as you're up at least 1 R, meaning 1 reward unit compared to your risk, right? Let's say you risk $500, and once you're up $500, this is my golden rule, and this is what I have been doing for years and years and years. Once I'm up 1 R, I immediately raise my stop to a break-even level and let the trade go in my direction, not unless I see, heavy resistance or market conditions have changed, and then I'm going to raise my stop even more. I'm not going to take myself out of the trade, but I'm going to raise my stop a little bit more. So in case of a market aversion, I'm going to be trailed out of that trade. Trailed out has a positive connotation. It means that you either trailed out of that trade with money, or you have trailed out of that trade at break even. But even regardless, you actually are positive. So you didn't lose anything on that specific trade. Okay, let's talk a little bit about the pros and the cons. Okay, let's talk about the pros. Okay, well, it keeps your losses to a set and limited dollar amount. So remember, I'm position sizing for my $500 a trade. Okay, it acts as what? As an insurance policy to prevent a bad trade from costing too much and taking too much out of your pocket cost, right? So you don't want to pay extra, right, for your trade. You don't want to pay extra. So when you're trading your Apple or Facebook or NASDAQ or Russell or whatever you may be trading, even if you're trading the dollar or if you're trading gold or oil, when you have a hard stop, okay, and when you have a stop, it prevents you from losing more than the allocated amount. So you're not going to bring money from the table, right? Okay, here are some cons to the hard stop. Well, at times you're dinged out of the trade, you're stopped out to the penny. Why? Because your brokers are selling what? Your order flows. And sometimes that penny stop out, especially happens especially in the first hour of the trading day. Okay, in the first hour of the trading day. What is the first hour of the trading day? Okay, what is the first hour of the trading day? Because when you're when we're talking about futures, we have a continuous market. It's close to a 24-hour, right? First hour of the day is always considered the New York trading session. Okay, first hour of the day here in the United States is considered the first hour at the beginning of the New York trading session, meaning from 9:30 until 10:30. Okay, sometimes hard stops. So you're gonna give it, let's say you're $500. You want to have a risk amount. You don't want to go above that $500, and you're putting your risk. But there are some certain disadvantages to that, because sometimes the hard stops accumulates 1 R losses. What that means is that you're going to lose your risk amount and your risk amount and your risk amount, and they're going to pile up. Okay, And sometimes it makes it a little bit tough to recoup all of the losses. So at the end of the day, it's all about balance and mastering the art of placing stops. Because right now they're running stops left and right. The market has shifted to a weaker pace, and even a slower pace. Looking at the time. Looking at today's trading environment. So actually we had, and it's pretty much, it resembles Fridays, and this is nothing else than Friday's trading. In Friday's trading, what happened? We had the first 15 minutes, which we had extreme price action, and then we had a chop for throughout the trading session, okay? So it's all about mastering the art of placing stops, but you have to be a very good market technician, technical analyst in order to do that. So how many times has this happened to you? And I have asked you this before. You found a great trade, it hit your targets, but you were not in the trade. Why? Because you were dinged out of the trade. Okay, you were dinged out of the trade, or you even trailed too tight. But what if I told you there's a way to feel more comfortable in a trade and not to incur multiple stop losses, but actually trade, guess what? Price action, right? Because every single tick and every single penny in the market forms this price action. But how? Number one, when I see a volatile market environment or a day like today, where we have strong divergency, we have a lot of chop that is happening in the market. Well, topping tails, bottoming tails, not my favorite thing. And also, we don't have very clear patterns. Guess what? If I do not have an identifiable good pattern, I'm not trading, okay? I am literally not trading and sitting on the sidelines. And in fact, today, from when we've opened, I did not have a trade. Okay, I did post some trading ideas in the in the market outlook that I've done, and you can have it on YouTube. I'm in a position in oil, and I'm waiting for a position in gold for long. Okay, but other than that, and all these are mentioned in the market outlook. But other than that, I am not in any day trading position as of right now. Those two are swing trades. Managing them, I'm not doing anything so far. But just to show you how much discipline I have when it comes to trading patterns. So the other thing is reducing your position size to half. This is one of the most important things. When you are unsure of the market bias, when the market is choppy, when you're seeing a lot of volatility, volume is subsiding in the market, and usually after 11:30 when the London market closes, especially in the futures market, and we're entering the doldrums. This is valid for stocks as well. It is wise to reduce your position size to half. So when you're identifying a pattern with a trigger, with a correct stop, you can position size to half of your size. Meaning, remember my $500 loss limit, I'm going to be reducing that to half. So I'm going to be only risking $250. Okay, and by doing this, I am actually doubling my stop. Okay, I'm actually doubling my stop because my size allows that. Okay, and this, by applying this quick technique, it is a very easy technique and a great profitable technique, especially for the summertime, because we're really thrown into the summer trading right now, and especially after FOMC, and we have about 3 to 4 weeks of very active earnings, and then after that, through the month of August, we're going to be in full summer trading. Okay, so this is that's why I thought this would be a great idea to teach you what I do with what I do on each and every single trade, especially in the summertime, right? And this is a great technique to use as well around holiday season, right? As we're getting, into Memorial Day and then going into Thanksgiving and then going into Christmas, I always love to be a little bit more protective. So I reduce my size to half and I double my stop. This strategy is great if you are coming off a losing streak. Remember, the one thing that you want, if you have been in a losing streak, is to use your entire position size. You have to take a step back, use half the size, okay? And this method will allow you to actually add along your trade. If there should be a trend that should be developing, let's say NASDAQ right now is trading into support, right? But if it blows through that support level, guess what? It's going to head even lower, okay? So when you're having, let's say, a trend develop, let's say we're getting right now, the hourly chart is definitely projecting lower. Any pullback, let's say you're getting in at a high, right? And you're shorting with half of your size. Any pullback that occurs from that established low, shallow bounce, dead cat bounce, whatever you want to call it, you can add your other half at that shallow bounce on that sell. Remember, you're adding just that half in for a further, and now you're invested for a further continuation lower, and now you're fully invested. Okay, you have some banked money, and then you can let your trade follow through to target with full position size, right? Because you're confirmed on the trend. So so like I said, this method would allow you to add to your trade along the way, and you're not going to feel pressured. When you have smaller position size, you will not have the tendency to micromanage because you're not going to feel that pressure from the high risk, right? And remember, when we're, trading money, right? What is money? Money is the most precious commodity, right? So you're going to be filled with emotions. Now, I know there are a lot of, traders out there that are telling you, oh, if you have a trading plan, that's going to be fine. It's, it's going to eliminate emotions. No, it's not. You're still going to be trading money. You're still emotionally involved. From the moment you push the trigger and when you're into that trade, your capital is at risk. And guess what? Your money is on the line and you're going to be emotionally involved. But if you have a less of a risk, that's easier to digest. So you're not going to feel as anxious. Okay, and then you're going to get in the habit of winning. Okay, so let's talk about the types of stops that we have here. First of all, there's the hard stop. Everybody knows the hard stop, right? A hard stop is a price level that, if reached, will trigger an order to buy or to sell. It's a trigger to get out of the trade. Hard stops are used to protect us, the traders, and most importantly, the capital, in case of a sudden price reversal, and it limits the risk. So we talked about the pros and cons of the hard stop. The hard stop is right there, is right on the chart. What about a soft stop, a flex stop? A flex stop is a soft stop. It's also called an intelligent stop, and we're going to get into this. A mental stop is an order that is not placed on the brokerage account, but is the position that is open. So you have the open position with no offsetting order to control the loss. So that means your 100% participation on that chart, right? So you're not going to leave your computer. A stop order is not placed, but the trader will still have that level in mind, right? He will be watching, he or she will be watching that level where he will prepare to exit the losing position, right? Okay, so what are the advantages of the soft stops? One common frustration for traders is setting a stop level, then having that stop level triggered, right? Stopping you out of the trade with a loss, and then the instrument, whatever you're trading, futures, forex, stocks, etc., turns around and it goes in your desired direction. I've had that multiple times happen to me, okay? And this is why I literally came with a different approach when it comes to my trading, my personal trading. And this can be avoided by using these soft stops, okay? Trailing stops, you apply them only to winning trades, right? So you're either literally squeezing your profits either to the upside or the downside, whether you're long or short. By applying technical trailing, this is a technical trailing strategy because this trailing technique is based on technical analysis. So it's not just I'm raising my stop out of the blue just because, you know, I just feel like it. No, you have to look at the technical levels from your charts, and the technical levels are going to be the only ones that are going to show you where you need to raise your stop or to lower your stop, depending on whether you're long or short. Okay, so you can lock in profits. Okay, this is how a hard stop looks like, and I did this slide about a week and I would say a week and a half ago. I think it was on July 20th. All right, so here's the hard stop. Okay, this is a short position. This is a short position right here. You can see the short. Okay, this is one contract. This is my brokerage platform, 2805. And you can see my hard stop. Now, note where my hard stop is. Okay, please note where my hard stop is. It's not at the top of the pivot, right? It's trading right now at 2804.5. I'm not squeezing it to put my stop at break even right now. It's just trying to let go. Okay, it's just trying to let go. So you can see that I'm placing my stop a little bit higher. Why? Because I'm staying away from the whipsaw of algos and all those stop hunts, right? I'm just staying a little bit away. Soft stop or intelligent stop is this is how I place my hard stops. So remember, they're mental stops. But for I don't want to lose sight of them. I usually take multiple trades. I'm in tons of you know, stock trades or futures trades, but when I'm trading and if I don't want to put a hard stop, I just don't want to let it float. So I put tons of alerts around that area, okay, where I want to have my stop place. Now remember, in the prior slide I had a hard stop place at 2808.5, and in this case I'm placing an alert. Why? Because the alert will sound at the moment it's triggered, and not only that, but it will sound on my phone. So if I'm traveling away from my computer, I always go anywhere through the house and I'm carrying my phone, right? If you're in a trade, you have to make sure that, you know, you're taking a quick lunch break, you're setting your alerts. You have to make sure that if you're not watching charts, you are definitely keeping an eye, and your alerts are keeping an eye for you. So have an alert. It is so easy, and it can be applied. It can be actually set on any kind of platform. And that alert is going to give you a heads up. Hey, you know what? Price is trading in that area. You better get back to your computer and see what the price is doing. Okay, we're not going to get into details on how to place the stop after the alert is triggered. Okay, so this is something that I'm going to teach in class. So trailing stops. What is a trail stop? A trail stop is, for instance, this is oil. This is a long position at 67.92, right? 67.92 here is to the trigger. This would have been the hard stop at 90. This actually had a really tight stop here, and it was the trade executed by me on July 20th. And you can see that as the price of oil was rising, by the way, this is a crude oil chart, as the price was rising, for example purpose, I've only used one contract long here, I have raised my stop. So the hard stop would have been right here. Let's see if I could get this little cursor going. All right, the hard stop would have been here at below 67.90, so into the 89 zone, right? So what it means is that when the price is pushing a little higher here over the over my buy area, and when we're reaching close to a target level, I'm raising my stop, right? I'm raising my stop, and you can see that I have raised my stop a little higher here. Okay, so that means that I'm squeezing the trade a little higher because I'm not willing to give back part of my profit. Okay, I'm not willing to do that. All right, now using soft stops with market tempo. What does that mean? What does the market tempo mean? Well, the market works. How does it work? The market is up, down, up, down, up, down, right? It moves in oscillations, right? It's basing at the low, moving higher, it's getting into an acceleration phase, it bases, and then it moves back down and so on, right? So it's not linear. So what makes the market tick? Well, there are certain times, right? So there are all sorts of traders that trade shorter time frames, traders that trade a longer time frame. Well, this push to the upside is created by what? By volume. A lot of traders getting in at a certain trigger, and this creates what? The pump up, right? So it creates the move up. Now, at the move up, there are some traders that are still invested in the trade, depending on the time frame they're using. If there's a trader invested on the 4-hour or the daily on that longer time frame trigger, well, they're not willing to leg out of their position. So what it means is that they're holding on to the positions, but there are short-term traders that are taking profit, right? They're taking profit. Now, these short-term traders that are taking profit are creating the pullback, okay? Are creating the pullback. Now, how steep or how shallow, we're going to talk about that in the next slide. These are the major reversal times in the market that I want you guys to take notes. You can actually write them down on a little post-it, stick them to your monitor. This is going to be extremely useful. So this is the first major reversal time in the market at 9:45. The following one is at 10 o'clock. 10 o'clock is a huge reaction time in the market. At 11:30, that's when you're going to expect things to move again, and 2:30. These are the major reversal times throughout the trading day. And knowing how to work around these reversal times, there are certain trigger times, and these are proprietary to my trading method. And this is something that we teach in class. This is something that we trade with every single day, day trade with, swing trade with, in our trading room. So trigger times out at 9:32. So remember, in stable market conditions, when you're not getting the initial volatile move and the whipsaw that we have been experiencing lately, usually the market balances out between 9 o'clock and 9:30 and 9:02. If the volatility is higher, that chop may be increased all the way into the 9:45. Okay, but keep in mind that in really good direction markets, high probability directional markets, at 9:32, you're probably gonna move in a very strong market condition. 9:32 is gonna be your trigger for a continuation higher, or in weak market environments, your 9:32 is gonna be the trigger for a continuation lower. Today was a good example of that, okay? Unfortunately today, because I'm trading day trading futures, those ranges, those 2-minute ranges were way too wide to execute, okay? So I didn't take any trades today. The next trigger time is at 9:35. Usually things balance out around 9:35, and then we have the next trigger time at 10:30. 10:30 is also one of my favorite trigger times. Guess what? Guess why? Well, by 10:30, pretty much the market is stabilized. It's either trading at the highs into 10:30 or at the lows in 10:30. So if they break the 10:30 high or the 10:30 low, it means one thing. If they're breaking the lows into 10:30, they're going to continue lower. If they break the highs into 10 o'clock or 10:30, they're going to continue higher. And the next trigger time to conclude the morning session is going to be at 11:45. So we just triggered about 20 minutes ago. Okay, so this is how the market tempo works. Number one, market opens at 9:30, right? Between 9:30 and 9:32 to 9:35, you're going to have the opening calibration, the balancing, right? The chop. You're either going to get a straight move to the upside or a straight move to the downside, or that chop, the sideways range. And you're going to have to wait for that and take action based on the 9:32 and 9:35 effects. 9:45 is one of the I would say reliable trigger times that happen in the market. Okay, 9:45 is a really good reliable trigger timing. If you're a day trader, you have been day trading for a while, you have probably seen that you've taken a lot of trades into the 9:45. If you're a gap trader, if you're a futures day trader, this is something that you need to watch for, the 9:45. 10 o'clock is that reversal time. So remember, if things start moving higher from 9:30 or from 9:45 to 10 o'clock, at 10 o'clock, things are going to shift. There are a lot of traders that are going to be looking to take some profits into 10 o'clock, right? So the momentum is literally going to go down a little bit. And as I'm looking right now, the markets look a little lower right now. Okay, so at 10 o'clock, you're going to expect that reversal time. Now, depending on how that 10 o'clock reversal is coming in, shallow or steep, I'm going to show you on the next slide. At 10:30, you're expecting the trigger time. So by 10:30, markets are pretty much showing you the direction. So at 10:30, you're going to be looking for a continuation higher or lower. I typically like to look at a little bit larger time frames when I'm trading into 10:30, so I'm going more by 5-minute or 15-minute. That's going to bring me more clarity. It's going to cut some of the noise out. And then from 11 o'clock to 11:30, guess what? European markets close, and it's up pretty much to the U.S. market to take the price, whether higher or lower. And then from 11:30 to about 1:30, doldrums. So what that means is that multiple levels of support resistance are being tested within this time frame. Tight stops. If you're one of those traders that loves to trade the tick chart, 1 or 2 minute charts, guess what? Multiple stop outs. You know who you are. That's one of the reasons, right? Because the doldrums are very choppy. Remember that support resistance. When you're trading the doldrums on the 1 and the 2 minute, they're not going to hold. They're not holding. So you're going to have to navigate to a little bit of a higher time frame. All right, let's talk a little bit about the market tempo. And I'm running quickly through slides. I prepared a bunch of information for you guys. I want this to be an eye-opener and a little bit of glimpse of what we teach and how highly we teach the high level of technical analysis that we teach in our classes and the high level of technical analysis that we apply every single day to our trading for a maximum accuracy. So when we have, let's say the market opens at 9:30, we have the projection that is moving higher, right? So we're getting the dynamic push to the upside. Now, remember, this can be the other way around. So from 9:30 to 10 o'clock, we could have what? The push to the downside, right? In a bear market. The example right here is only for the bullish market. For the bear market, just look upside down. Okay, no, just kidding. Just just imagine the downtrend. Okay, just imagine the downtrend. So you're moving from a point A to a point B that is lower, and actually to a point C that is a shallow bounce to the upside. Okay, and so from 9:30 to 10 o'clock, you're going to get that boom bounce to the upside, and then depending on how this pullback is, how shallow or how steep, this is going to dictate the tone for the rest of the day. That's why I love the 10:30 time frame, because at this point, the reversal that comes in at 10:30 is going to give me a better idea of where the things are moving. If I'm getting a shallow pullback testing the 9:30, we're most likely going to have a range day. But if the pullback is shallow, we're going to have a trend day, and I'm going to be looking. So by knowing what kind of day I'm having, whether it's a trend day or a sideways day, I know how to adapt my trading style. Because if this pullback is going to come back into the 9:30, guess what? If it brings the 9:30 low, then most likely we're going to head lower. We're probably going to shift directions, okay? But if it is shallow, then guess what? I'm going to get in volatile conditions. Volatile conditions, and then we may reverse and continue higher. Now, the move that occurs from 10:30 until 11:15 or 11:30, this is going to be a little longer in duration, because when you're having confirmed markets, you're confirmed markets with directional bias. That means you're going to have that smooth ride to the upside. Into 11:30. So 11:30 is the next reversal time. So 11:30, you're going to be looking to lock in profits as well. But what happens if the market is choppy right from the beginning, right? Not all the time. So today, in today's example, in today's market, we had a straight push to the downside. I'm just going to put it very quickly here. Notice the weakness in NASDAQ, right? So we had a straight push to the downside, right? What that means is that we're more bearish inclined, right? But when you are having the chop, right? So from 9:30 to 9:45, this is basically taking a little longer because it's digesting, guess what? The overnight price action activity, and it's trying to find balance, trying to find the new support resistance levels from which it's going to either trigger higher or lower. If it should move higher, it's going to move straight up into 10 o'clock, right? And if that is a strong market, it's going to move straight up to 10 o'clock, or it's going to move back down. And a day like today, it moved continuously down. So depending on the pullback, how shallow or how steep, this is going to be the next reversal at 10:30. That's going to carry the price a little higher. So you get a little bit of feel of that. All right, now hard stop versus soft stops. When to use hard stops? Number one, when the mini commodity stock, ETF, etc., whatever you're trading is into an established trend. Okay, so you're having an index or a commodity that is into an established trend, making what is a confirmed trend? Anybody know what a confirmed trend is? At least, you know, you have to have a succession of higher highs and higher lows, right? And any pullback is buyable, and any pullback is a test and retest, and that's when you can use the hard stops, right? Because you're having that established trend. All right, and stops and pivots are more likely to be to hold because the velocity is pushing the price to the next levels. When to use soft stops? When the price becomes dicey and choppy, and when you have multiple support levels or resistance levels, if you're trading to the downside, that are really close by. Okay, that are really, really close by, and those are called confluence areas. Whether support, resistance, they're slicing, they're really slicing at certain levels through price. Okay, let me show you a quick example here, and in fact, this is a presentation, like I said, that I've done at the Futures Traders Expo in Chicago, in the Trading Pick, where when I started talking about this touchy subject about the stops, not only that I had a full packed room, but people were standing up for this presentation. And it was very rewarding for me to see that I had in the audience some of my traders from my students and some traders from my trading room. So it was a joy to see them there. All right, so here's an example, and this is from a week and a half ago. This is Russell. And in fact, not from this Friday, but from last Friday. This is Russell Long. It was a buy trigger. Remember, it was in a strong confirmed uptrend, okay? So Russell had a buy trigger over 1700. You can see the area right here. And the timing was at 1026. Now, the reason why I'm saying that 1026 area is because what? Remember the 1030, right? 1030 is the trigger time. So this is why I love this trigger long at right here at 17. Now what happened here is that it already triggered, okay? So my stop would be what? Would be, because it triggered here, my stop would be 16.99, right? So that's a 1 point risk. So remember, the entry is based on the 2 minute because we're talking about day trading right now, day trading. Let's take a look at the second slide, right? You can see the support level from the left-hand side right here, and you could see the reversal point at 1700. Now, remember, the first stop loss area and the first support level from this prior slide is right here at 1700. So you're going to give it what? You're going to give it about a point. Why? Because you're trading into support. Now, when you're looking at a 5 minute chart, and especially when you're navigating a little bit away from the opening ticks from 9:30 to 10 o'clock, you're looking at this pattern here, and you're seeing that to the left-hand side, you have another support level. This is the only time when you can apply the soft stop strategy, right? Why? Because I had a stop, I had a support level at 1700, and I have another support level at the 1698. So this provides me with that cushion where the price may pull into, reverse, and continue higher. So therefore here, you can see that target levels obviously are running for higher into the 1706 and 1707. Obviously, targets are set into prior resistance areas, which are the prior highs, whether they're happening at the newer trading session or whether they're happening into the overnight trading session. Because remember, if you're trading futures, it is a continuous market. You're having access to these to the price information 24/7. Okay, so after 5 minutes, after the 5-minute reversal triggered at 16.99, I have immediately placed my stop after below this pivot low. Okay, and you can see it right here, 15-minute chart trigger, and you can see my target, how this trade achieved my targets. Okay, how this trade achieved my targets. All right, now let's do the math. The entry was 1700, the stop 1798, and that was the final hard stop, right? Because it was into what? It was into second support level. Target 1706, 1707. Risk, you're risking 2 points. A point is $50, so therefore for one contract, that is about 100 points per risk. Guess what? If you're using a risk, because I gave you this example, if you're using a risk of $500, then guess what? You can actually can take the trade with 5 contracts. Well, it obviously depends on your account size, and profit 1750. So when the technicals are there and you have a strong understanding of technical analysis, it is wiser, guys. It is wiser to use the soft stops when the price is trading in a confluence area versus stopping out by the tick and then reinitiating the same trade over and over again. So when to use these intelligent stops? Number one, in trending markets and in trending patterns and in sideways patterns that are developed in confirmed trends. Intelligent stops will stop working when the trends are changing. Okay, I didn't have time to update this presentation, but we had a trade on Friday that has violated our first area of support. We lived through the drawdown and Russell. We finally had the reversal, placed a hard stop, and it took us out. Okay, so that was a loss. Okay, so are intelligent stops riskier? Question number one. Is it riskier to use soft stops? Well, let me shed any kind of doubt that you have. If you're using half of your size, no. As you have the rotation on the secondary support resistance level and you place a hard stop, now the second hard stop becomes your second support level becomes your hard stop. Okay, but you have to have a very thorough understanding of technical analysis. You just have to do what you have been doing if you're doing successfully until now. Number two, if you're using the full size, and basically I was using the full size on Friday. If you're using the full size, you are going to add, okay, as the next buy setup is going to occur off the secondary support level. Okay, and this is your add is basically going to be, and it's going to be seen as a second trade, right? As a second trade out of your 3 or 6 allocated trades per day. As a day trade, you're going to allocate yourself what? Your 3, 5, 6 trades. Everybody's different. I know a very successful day trader that he actually trades a lot, and he takes I don't know, maybe 20 trades a day. Okay, but it all depends to the trader. Intelligent stops work 75% of the time, close to 85% of the time, okay? And it's wiser to use these soft stops. Now, I have a class that I will be teaching. It is called the Power Income Day Trading Futures Bootcamp. It is the 30-day class. It starts August 10th. So, boom, we're going to start it off, kick it off next week, next Monday. It is from August 6th to September 10th. It is a 30-day, 5-day packs with trading education. It's going to be live online. I'm going to be teaching the class. If you want more information on that, you could email me at info@tradeoutloud.com. I'm going to send you the full class curriculum and everything that you need to know. I'm going to be teaching the most powerful day trading chart patterns and how to exploit them for above average gains. The 6 major disciplines. What is a trigger? What is a trigger? What is an entry? What is a stop? What is a target? How do you calculate those? How to manage your trade? How to position size etc. I'm going to be teaching you obviously more detail about the market tempo, right? So there's so much more than I have discussed today about the market tempo. How to maximize your timing using key moving averages and other powerful indicators that are free to use. So you're not going to need to buy anything, right? So they're free to use. They're with any broker, so they're going to be fantastic. And how to maximize your gains and minimize your losses using proper money management techniques. And this is big, right? How to maximize gains and minimize losses using proper management techniques. Also, market timing. When is the right time to buy? When is the right time to sell? When is the right time to short? Or when is the right time to keep on going, pull back, buy, pull back, buy? And also precise locations, okay? I'm going to be teaching you those 4 price points where you could actually see institutional buying popping in, or institutional selling, or stalling, or not doing anything, not taking on any kind of action, okay? I'm also going to be teaching you how, by looking at one time frame, when you get up early in the morning, you're going to be looking at only at one chart. You're going to be looking at one candlestick, and that's going to tell you exactly whether you're going to be bullish or bearish. Okay, so that's very, very important, with maximum high odds for that technique. And it's a very simple technique. It can be applied at the New York Trading Session Open. It is incredible. Okay, it is incredible the way it works. And also advanced technical analysis skills. And I am going to teach you everything you need to know about technical analysis. Whether you're trading stocks or forex or futures, anything that there is. With this class, obviously, I'm going to be teaching it live, okay? So if you have any questions along the way as I'm teaching, boom, you're going to be asking questions. You're going to receive your answer right on the spot. So you're going to, there's no homework, okay, involved. So you're going to come into class. You have to understand everything from the class. Best of all, you want to revisit the class, you're going to have access to the on-demand recordings. More so, you're going to have access to unlimited live retakes. I'm a strong believer that you cannot learn how to trade from a DVD or a book. What are you going to do? Call the author? He's not going to answer. He wrote the book, he's done. If he or she came out with the DVD, guess what? What are you going to do? Call her? Try it. Just try it. You're never going to get an answer out of them. Listen, I've been in this industry long enough to know, a lot of the things that are going on. The fact that I'm offering the live retakes, it means that we have been here for a long time, and we're here to stay. I'm a trader. I love to trade, and I trade every single day in my trading room. You're also going to have access to workstation initiation. This class is going to take you from a beginner trader. It's going to close the gap to proficiency. The more you access and the more you come and take the live retakes, every single time you're going to get this aha moment. Keep in mind that I'm teaching a manual that has 400 pages, but I'm speaking more of like 1,200 pages because I'm explaining everything over and over again, and I'm coming with charts, and we do chart analysis live. I'm also going to be offering you my platform layout. Whether you're using my broker or not, it will allow you to have your workstation all set up. All right, so remember, the boot camp starts next week on Monday. It is from 6 p.m. to 8 p.m. for the training. I used to do this on a weekend, and my students' heads would spin, okay? So we chose the better solution to have 2 hours every single day. Once you sign up, I'm going to be sending you the introduction, which is recorded, which basically is going to teach you about what futures are, who trades futures. We're going to teach you about algorithms, hedge funds, etc., how they work and what they look for, and and all those details, the contract size, so you get a better understanding of margin and every little single detail. And then when I come in, we're getting right into candlesticks and right into patterns. Then we're getting into technical analysis and market tempo, and then at the end into strategies. And then you're going to be trading with me live from August 10th to September 10th from 9 o'clock to 4 p.m. Eastern every single day. The mornings are very active from 9 o'clock around to 11 o'clock or 11:30. Then the doldrum period, we're going to start watching. Then our focus is going to shift to different time frames. So I'm going to teach you how to create that stereotype so you get into the habit of having a winner's mentality. Okay, so if you want more information about the class, you can email me at info@tradeoutlet.com. More than happy to provide you with a lot of information about the class. And like I said, I'm throwing in, it is a 30-day boot camp. I usually host only the class and not offer the boot camp. So this is the package that is already set up. So let me know if you guys have any questions, and I'm more than happy to talk to you about the class and the trading room. So like I mentioned, I also run a trading room from 9 o'clock to 4 o'clock. We day trade futures and we swing trade stocks and futures. Okay, we actually have an active trade in gold right now. We have I have a beautiful trade in CL. I don't know if any of my students, I haven't had time to touch base with them to see if they actually got into oil. But this is what we do. If you have questions, thanks so much. Tanya, thank you for having me here. Traders Talk Live, you guys rock. I'll see you guys next time. Looking forward to the next presentation. And shoot me an email. Give me some feedback on some things that you want to hear from me next time.